The news says the economy is booming. Unemployment is low. Stores are full. Your friends are posting screenshots of their growing 401ks. And then suddenly, in one ugly week, the market tanks. The Dow's down 2,000 points. Your retirement account loses months of gains, and you're sitting there thinking, wait, I thought everything was going great. What just happened? If you've ever felt that punch in the gut, you're not alone. It is one of the most confusing things about money in America. How can markets crash when the economy looks strong? Isn't Wall Street supposed to reflect Main Street? If the economy's solid, why does your 401k suddenly look like it fell down a staircase? In this video, we're going to walk straight into that confusion and untangle it in simple, everyday language. No PhD, no Wall Street job required. Just you, me, and a conversation about how the system actually works. By the end, you'll understand why these out-of-nowhere crashes happen, what's really going on behind those red numbers on the screen, and most importantly, how to think about your own money so you're not getting yanked around by every scary headline. Let me start with a little story that might sound familiar. Imagine it's you, a few years from now. Life's okay. You've got a job. Maybe you're not rolling in cash, but you're paying the bills. The news keeps saying, soft landing, no recession, economy surprising to the upside. Your company just had a good quarter. You've been watching your 401k climb slowly higher. You're finally starting to think, maybe this retirement thing is actually going to work. One Friday morning you wake up, grab your phone, and see a push alert. Markets tumble on Wall Street. You shrug. It happens from time to time. Then you open your 401k app and see a number you don't like. Down thousands, just like that. Over the next few days, it gets worse. CNBC is red all over. People at work are whispering in the break room. Someone mentions 2008. You refresh your accounts again and again, even though you know it won't help. But when you look around your actual life, nothing changed. Your job is still there. The Starbucks line is still long. The mall parking lot is still full. Gas is a little annoying. Groceries are always high, but nothing feels like a disaster. You're stuck between two realities. Your day-to-day feels normal, but your investments look like somebody lit them on fire. That gap between how the economy feels and how the market behaves is what this whole video is about. Here's the first thing you need to know. And it's not something we're really taught in school. The stock market and the economy are related, but they are not the same thing. Think of them as cousins, not twins. The economy is your world, your job, your paycheck, your rent or mortgage, the businesses in your town, the stuff you buy, the services you use. When the news talks about GDP, unemployment, consumer spending, that's the economy. It's Main Street. It's what's already happened and what's happening right now. The stock market is something different. The stock market is a giant, messy, emotional voting machine about the future. It's Wall Street. It's millions of people and algorithms guessing, and that's the key word, guessing, what company profits, interest rates, and risks will look like 6 months, a year, 5 years down the road. The economy asks, how are we doing today? The market asks, how do we think we'll be doing later? So when you see a strong economy and a crashing market at the same time, what's usually going on is this. Today still looks good, but investors suddenly got scared about tomorrow. Let's make that really concrete. Imagine you own a small coffee shop. This month you're doing great. Lines out the door in the morning, people working on laptops all afternoon. You look at your numbers and think, this is my best month ever. That's the economy. It's what's actually happening. Now imagine someone tells you, hey, starting next month your rent is doubling. Your coffee beans are going to cost 30% more, and a Starbucks is opening across the street. Today's numbers might still look amazing, but your brain just crashed your future profits. That's how the stock market works every day. It isn't paying you for today's good news. It's constantly trying to figure out what happens next. And when the picture of next suddenly looks worse because of interest rates, inflation, wars, elections, debt, or just broken confidence, prices can drop fast, even when today's headlines are still glowing. Now that's the big picture. But you didn't click on this video for one simple sentence. You want to understand the moving parts, the why behind those crazy days when your accounts swing wildly and the economy still seems fine. So let's walk through how that happens in real life, in a way that actually sticks. Start with this idea. Markets crash when expectations break. Markets don't just price where things are. They price what people expect will happen. If everyone on Wall Street expects a company to earn $10 a share and it earns $9, that's still a lot of money in real life, but it's less than expected and the stock can drop. The same logic works for the entire market. In long stretches of calm, with good economic data, expectations tend to drift higher and higher. People start to assume profits will keep growing, unemployment will stay low, inflation is under control, interest rates will stay low, nothing huge is going to blow up. And here's where Americans especially get pulled in. The higher prices go, the more normal they feel. A stock that used to feel expensive at $100 starts to feel normal when it hits $150, then cheap on a dip at $140. We move the goalposts in our minds without even noticing. You've probably heard the phrase, priced for perfection. That's what we're talking about. When the market is priced for perfection, it means a lot of good news is already baked into stock prices. So if reality slips even a little below that perfect story, prices don't just gently adjust, they can drop hard. Let's bring in something very real to Americans, the Federal Reserve and interest rates. Most of us interact with interest rates without thinking about it. Your mortgage payment, your car loan, your credit card balance, your savings account, all of that is tied one way or another to interest rates. When the Fed keeps rates low, borrowing feels cheaper and investing feels more attractive. When rates go up, the opposite happens. Now imagine the economy is very strong, low unemployment, people spending, wages rising. On Main Street, that feels good. On Wall Street, that often triggers a different thought. Uh-oh, if things keep running this hot, inflation might pick up and the Fed might raise rates more. Why does that matter to the market? Because interest rates are like gravity for stock prices. When rates are low, money flows easily into stocks. When rates rise, safer options, like treasury bonds or even savings accounts, become more attractive, and future profits from companies are worth a bit less when you discount them back to today. So you'll sometimes see this strange headline, "Stocks fall on strong jobs report." It sounds totally backwards. People are getting jobs, getting paid, spending money, and the market falls? But under the surface, investors are thinking, this strong report means the Fed might keep rates higher for longer, which is bad for high stock prices. The key thing is this: none of that shows up in your life right away. Your paycheck doesn't suddenly change because the 10-year Treasury yield moved. Your job doesn't vanish because the Fed hinted at another rate hike. So your personal economy can feel solid even while the market, which cares a lot about interest rates and expectations, starts to wobble or even crash. Now let's talk about something that really turns those wobbles into full-on crashes: debt and leverage. In good times, when the economy is strong and markets keep going up, people get comfortable with risk. They borrow more. Individuals might use margin in their brokerage accounts. Hedge funds and big institutions borrow billions to amplify their bets. Companies issue cheap debt to buy back their own stock. On the surface, everything looks fine. Underneath, there's a lot of borrowed money propping up those prices. Here's the problem. Borrowed money cuts both ways. If you buy $10,000 of stock with your own cash and it falls 20%, you lost $2,000 on paper. Painful, but you're not forced to do anything. If you buy that same $10,000 of stock using $5,000 of your money and $5,000 of borrowed money, and the stock falls 20%, you're suddenly in a very different place. Your broker might call and say, "You need to put up more cash or we're going to sell your shares." That's a margin call. When that happens across millions of accounts and thousands of institutions at once, you get wave after wave of forced selling, not because the real economy just collapsed overnight, but because the financial system is designed to protect the lenders first. Positions get cut. Risk gets reduced. People sell what they can, not just what they want to. So a typical pattern looks like this. Expectations were high, prices were high, leverage was high. Then a piece of news hits. Maybe it's about interest rates. Maybe it's about inflation. Maybe it's something geopolitical, and prices fall a bit. That small fall triggers margin calls and risk limits. Forced selling kicks in. Prices drop more forced selling. Before you know it, what started as a modest adjustment turns into a crash. And remember, none of this requires that Main Street suddenly falls apart. You can have strong job numbers, solid GDP, people still going to Target and Costco, while the financial plumbing on Wall Street is under massive stress because of leverage. There's another character in this story we have to talk about. Liquidity. Liquidity is just a fancy word for how easy is it to buy or sell something without moving the price a lot. In normal times, if you own a big, well-known stock and you want to sell it, there are plenty of buyers at nearby prices. You sell, they buy, and the price only wiggles a bit. In a panic, buyers can disappear. Imagine you're trying to sell your house, and suddenly every buyer in your city decides they're scared of real estate. You can still sell, but only if you slash your price. That's what happens in markets during crashes. The number of people willing to buy at yesterday's prices shrinks, so prices have to drop to pull new buyers in. Combine that with leverage and you get a nasty loop. Falling prices trigger forced selling. Forced selling hits a market with not many buyers, so prices fall even more. And again, this can happen while your favorite restaurant is still packed on Friday night. Now I want to zoom out from all the mechanics, interest rates, leverage, liquidity, and talk about something more human, stories. Markets run on stories. You see it over and over in U.S. history. In the late 1990s, the story was, "The internet will change everything. Old rules don't apply. Growth is all that matters." People paid crazy prices for dot-com stocks that barely had revenue because the story was so exciting. In the mid-2000s, the story was, "Housing never goes down nationwide. You can't lose on real estate. Just buy more." That story powered the housing bubble and all the financial engineering around it. In the late 2010s, the story became, "The Fed has our back. They'll always step in if things get rough. Tech can grow forever. Low rates are here to stay." When a story like that takes hold on Wall Street, prices rise for years. Ordinary people start to believe it too. It shows up in casual conversations. "You gotta buy a house. Prices only go up." Or, "You have to be in tech stocks or you're missing out." Or, "The Fed will never let the market really crash again." And then, suddenly, something happens that breaks the story. Maybe a big tech darling misses earnings and reveals that profits aren't anywhere near the hype. Maybe a wave of mortgage defaults proves housing can absolutely fall and crash nationwide. Maybe inflation spikes and the Fed makes it crystal clear. We care more about controlling inflation than saving stock prices. When the story breaks, confidence breaks with it. Investors who were happy to hold at high prices under the old story suddenly want out. Not next month. Now. The same emotion that drove prices up, belief, now drives them down. Fear. From the outside, the economy might still look okay. Your neighbor still has his job. The local mall is still open. The unemployment rate is still historically low. But inside investor psychology, the world just flipped. And that flip, from "this is safe" to "this might not be safe at all," is what turns a calm market into a crashing one. So let's pull this together and put it in a sentence you can remember. Markets crash in strong economies because markets don't trade on today. They trade on a suddenly darker view of tomorrow, built on high expectations, high prices, and often a whole lot of borrowed money. Now, if you're watching this as someone living in the U.S., trying to build a future, maybe for yourself, your kids, your parents, the real question in your mind might be, okay, I get why it happens, but what am I supposed to do with that? How should I react the next time this happens? First, separate your life from the market's mood swings. Your job, your skills, your relationships, your health, your emergency savings, that's your real foundation. The stock market is important for long-term wealth, but it is not the scoreboard of your worth or your safety today. If the economy is still strong and your job is secure, a market drop hurts on paper, but it's not the same as a personal financial crisis. Second, remember your time horizon. If you're 30, 40, even 50, and you're investing for retirement that's 10, 20, 30 years away, the fact that markets sometimes crash during good economic times is not a bug in the system. It's how the system clears out excess and resets for the next cycle. Prices get ahead of themselves, reality taps them back down, and long-term investors who stay the course often end up okay. That doesn't mean it feels good in the moment. Seeing your 401k drop never feels good. But if you understand that strong economy plus crashing market is a known pattern, not a glitch in the matrix, it becomes easier not to slam the panic button at the worst possible time. Third, be very careful with leverage in your own life. Wall Street can get itself into trouble with borrowed money. So can we. Maybe it's a bunch of credit card debt. Maybe it's a second home that only works if prices keep rising. Maybe it's trading on margin in your brokerage account because the economy looks solid. When things are good, leverage feels like a non-issue. In a sudden market drop, it becomes deadly. The last place you want to be during a crash, especially one that happens during a still strong economy, is in a position where you're forced to sell or forced to cut back your life because debt is squeezing you. Building some margin of safety into your own finances is how you avoid becoming collateral damage when Wall Street hits a rough patch. Fourth, shift what you pay attention to. Instead of asking, is the economy strong right now? When you're trying to judge market risk, start asking, how high are expectations? Have prices been going up for years with very little pause? Are people talking like risk doesn't exist anymore? Is there a lot of talk about making easy money? Are interest rates rising after a long period of being low? Is there a clear story everybody believes that sounds almost too perfect? Those are the kind of conditions that often sit in the background before a market drop, even if the economic data looks good on TV. Finally, give yourself permission not to react to every crash. One of the hardest things in investing and in life is learning when not to do something. When you see market plunges in all caps, every instinct in your body screams, do something, sell everything, or buy everything, or switch strategies, or call your plan broken. But a lot of wealth in America is quietly built by people who don't try to outsmart every move. They pick a reasonable plan. They save what they can. They diversify instead of betting the farm on one thing. And when crashes hit, even crashes that make no sense on the surface because the economy still looks solid, they stick with the plan instead of letting fear write a new one on the fly. Let me leave you with an image you can come back to. Picture a crowded movie theater. The movie is great. Everyone's into it. The sound is perfect. The seats are comfortable. The popcorn smells amazing. That's your strong economy. Things feel good. Then someone in the back thinks they smell smoke. They're not sure, but they're nervous. They whisper to the person next to them. That person gets nervous too. A couple of people get up and head for the exit. Someone else sees them leaving and thinks, do they know something I don't? More people stand up. Suddenly a few people shout, "Fire!" Now everyone's running for the doors. Maybe there is a fire. Maybe there isn't. The point is, the rush for the exit can get dangerous, even if the actual fire is small or not there yet. That's the market during a crash in a strong economy. The theater, the economy, might still be mostly fine, but the crowd's belief about what might be happening is what drives the chaos. You can't control whether someone yells "fire" in the financial theater. You can't control when the crowd panics, but you can control where you sit, how fast you feel the need to run, and whether your whole life depends on staying in that exact seat in that exact theater. If this breakdown helped you see that weird disconnect, how your day can feel normal while your 401k looks like it got run over, I want to hear from you. Have you lived through a crash like that? Maybe 2008? Maybe the COVID crash? Maybe a smaller one more recently? What did it feel like? Did you sell, hold, or buy more? And looking back, what do you wish you had known then that you understand now? Drop your story in the comments. Your experience might be exactly what someone else needs to hear so they don't feel crazy or alone the next time the market acts up while the headlines still say, "Economy strong." If you want more straight-talk explanations like this about the Fed, inflation, recession fears, housing, or how to actually think about your 401k without losing your mind, hit that subscribe button, tap the like button so this reaches more people, and turn on notifications so you don't miss the next one. Thanks for hanging out with me and sticking through a tricky topic. Remember, the market and the economy live on different clocks. When the market crashes in good times, it's not the end of the world. It's a sign that the story about the future just changed. Learn to read the story, not just the scary headlines, and you'll be way ahead of the game.